Hi guys, welcome back to the channel. Lemonade keeps executing and the numbers from Q2 are proof. In Q2, in-force premiums reached $1.083 billion, up 29% year over year. This marks the seventh consecutive quarter of accelerating growth. Management has already stated that they expect to reach $10 billion in in-force premiums while maintaining a 30% annual growth rate, an ambitious but definitely achievable goal. The gross loss ratio came in at 67% compared to 79% in Q2 2024 and 94% in Q2 2023. This is simple AI in action. Over the trailing 12 months, the gross loss ratio stands at 70%, a fantastic figure right in line with the company's long-term target. When asked if we could see the loss ratio drop even further, CEO Daniel responded, "Never say never, but we aim to continue to drive our prices down. Killer pricing is a key differentiator which will drive greater conversion, lower acquisition cost, and higher retention. At some point, lowering loss ratio more than this just means we are not being as price competitive as we could be." This is key. Lemonade's strategy is to offer the most competitive premiums in the market. As I've said many times, and I will say it again, if customers can get significantly better prices from Lemonade, why will they go anywhere else? Much of this growth is thanks to the car segment. Car is going to be the next major inflection point for Lemonade, and even though we are only in the early stage, it's already delivering on that promise. In Q2, the car business delivered 12% sequential growth, outpacing the overall company for the second straight quarter. Management expects this trend to continue and become even bigger, especially because Lemonade Car is still in the early stages of deployment. It's currently available in just 10 states, with Colorado launched in Q1. Why can car be such a big driver? Because premiums here are much higher than any other Lemonade product. Average premium per customer is about $1,900 per year for car, $260 per year for homeowners, and $750 per year for pet. The Q2 car gross loss ratio was 82%, an improvement of 13 points year over year, and the lowest since the product launched. Another major growth driver is Europe. Lemonade now operates in Germany, France, the UK, and the Netherlands, serving only renters and homeowners, yet already has over 250,000 customers. Europe shows that Lemonade's AI-driven platform can scale into any market, regardless of language, product type, or regulations, without large local teams or country-specific infrastructure. In Q2, Europe in-force premiums grew over 200% year over year to $43 billion, contributing more than 20% of Lemonade's net new customers. Compared to when the United States crossed $50 million in in-force premiums, the European business has a gross loss ratio more than 20 points better. And that's not just a nice statistic, it's proof that the Lemonade AI model is becoming more and more accurate with each and every new data point. They are leveraging all their United States experience to scale faster and more efficiently in Europe, achieving better results at an earlier stage than they did in their own market. And they are doing it all while keeping costs flat. Excluding gross spend, operating expenses were down 2% from last year. In the last 2.5 years, in-force premiums has grown from $600 million to almost $1.1 billion, while operating expenses have actually fallen from $87 million to $80 million. To be honest, Lemonade took advantage of a one-time $11.7 million benefit this quarter, which lowered operating expenses, but even so, the takeaway is clear. Lemonade can scale massively while keeping operating expenses flat. That's how they can continue offering the best prices in the market. Lemonade is executing. The business model is proving itself, and I'm increasingly confident they can become a huge player in the $7.5 trillion insurance market. The market seems to be starting to realize the potential in Lemonade, with the stock up 60% over the past week. But with a market cap of just $4.4 billion, we are still very early. That's it for today. See you soon.